Calling all landlords. Learn how to navigate the complexities of taxation on buy-to-let properties and keep more of your money in your pocket. For those of you who are new to my channel, my name is Richard Norris. I've successfully built a multi-million pound property portfolio and I've been investing in property since 2011. I'm an owner and the founder of a company called propertyconsulting.io, and we help people to start and grow and even existing properties to scale their existing property portfolios to 7 and 8 figures. Now, with that being said, in today's video, I really want to talk to you about the world of tax on buy-to-let property. If you're brand new to property, this is going to be great for you. It's going to be super insightful. It's going to keep you up to date with the most recent tax changes, the taxation policies and regulations surrounding buy-to-let property in 2024. And if you're an existing property investor, this is just going to keep you up to date and informed with the most recent tax changes. Because one of the reasons why I decided to do this video is I think it's fair to say that if you're an existing property investor, you would agree that there's been a plethora of tax changes and punitive legislations that have been put in to kind of disincentivize and penalize landlords who definitely own property in their own name. Not so bad for limited companies, but the overarching theme from the UK government and George Osborne was, hey, we want to tax and go after landlords. And that's really been the overarching premise that we've seen as buy-to-let property investors in the UK. So with that being said, and because of the numerous changes that we've seen, I thought it'd be a great idea just to keep you updated and informed on all of the recent changes and how it's impacting you as a property investor for this year. So the first thing I want to talk about is probably the biggest change. And I'm going to talk about buying properties in your own name and then buying properties in a limited company, because naturally both of those have different tax regulations, rules and policies surrounding them. And so let's dive in and talk about taxation on buy-to-let property on a privately owned property rental business. So this is if you're buying properties in your own name. Well, the first tax change that we saw, this was introduced in April 2016, and it was a 4-year phased plan until April 2020. And it was something called Section 24. And basically what Section 24 said that if you're a higher rate taxpayer, so if you're a 40% taxpayer or more, then effectively you cannot offset any of your mortgage interest relief anymore. It's no longer an allowable tax deductible business expense. And so what that meant is that you were being taxed 40% on the gross rental profit minus your tax allowable expenses against your properties. And then you could basically get a mortgage relief. You could claim a mortgage relief back on the annual interest payments, and the mortgage relief allowance was 20%. And the problem with this is that many landlords really overnight honestly lost up to 50% of their gross rental profits, and some of them went into negative equity, particularly with the recent changes that we've seen where interest rates have kind of been fluctuating. We've seen a lot of instability in the market in 23-24 with mortgage interest rates. Yes, they've just started to settle and flatline, but they're still significantly higher because the base rate has risen from 0.1% all the way to 5.25% with 14 consecutive base rate changes over the last year or so. And therefore, these two things coupled together, the interest rate changes and the Section 24 punitive legislation against buy-to-let property investors who had property in their own name, meant that a lot of landlords kind of had to leave the buy-to-let property market because they could no longer make it work. However, I think that was a wrong idea for a lot of them, because many investors that I particularly have worked with and do continue to work with, many of them have considered incorporation, basically moving their properties from their personal name and incorporating their privately owned property rental business into a company. And we're going to talk about this a bit more as we go through the video today, but the taxation in a company is far more positive and it's a lot better than the taxation as a landlord who owns property in your own name. The first thing is on incorporation, you can wash out your capital gains tax bill, you can defer your taxes a lot better, and you do get 100% of your mortgage interest as a relief. It's a tax deductible allowance in a limited company. And again, not digressing too much because I want to talk about taxes on your personal name to start with. So the first one is Section 24 and the nuances around that. Now, to really substantiate this point and just how bad it can be, I really want to show you now a case study of a client of mine that has a portfolio of 11 properties, you'll see it's, a multiple 7-figure, if not 8-figure property portfolio. And you can see that the gross rental profit is around about the £500,000 per year. And they have a massive tax liability because of Section 24 finance restrictions. And to highlight this, I just wanted to share with you a spreadsheet and a case study of one of my clients so you can see the effect. Because it's okay talking about this effect on one property. When you have a plethora of property, the problem compounds. And that's the biggest problem with taxes. If you don't understand and build your property portfolio in the right vehicle, set up it in the most tax efficient way, then basically you're just starting to compound your problems. And it's kind of trying to build like your multi-million-pound house on sand. It's just going to collapse eventually. And this is one of the biggest problems that we saw with investors today that have property in their own name, and anyone who continues to buy property in your own name. Now, it's really important to talk about this as well. If you are a property investor and you're a lower rate taxpayer, so you're a basic rate band at 20% on income tax, then you don't have Section 24 to contend with. However, if you want my advice for what it's worth, like, you need to be thinking about the future proof. And if you're somebody watching this video and you're looking to get into the buy-to-let property market, I would assume that one of your goals is to maximize the profitability in your life, to make it as financially successful as possible. And therefore £50,000 these days, no disrespect, it's not a lot of money to live on in this day and age, in this economy, in the 21st century. And therefore I would assume that your goal is to become a higher rate taxpayer and you're not looking to cap your earnings. Therefore Section 24, if it doesn't impact you now, it will impact you going forward. And these are the things you need to think about. What I found, to be honest, working with lots of accountants and tax advisors, is accountants are very good at looking at the past, telling you, on a monthly basis what your profit and loss is and how much tax that you've got to pay for that accounting period, and they try and massage it and offset tax allowable expenses as much as they can, and then they report to HMRC on your behalf and say that my client owes X pounds in taxes this year. But that's not the best thing that we need, and you really need a good tax advisor, because a tax advisor, what they do is they look at the future, and you need a tax plan. What I'm talking about in this video today is highlighting your awareness and raising your awareness of the buy-to-let property market, the taxes that surround it, how you can calculate your tax as a buy-to-let property investor in your own name and a limited company, and how to be tax efficient, not tax avoidance, not tax evasion, but smart tax planning is what we need to look at. And it's those shrewd investors that act with perspicacity when they make their decisions and keep more of their rental profits that are able to defer taxes and build that compound interest effect into their business and grow their property portfolio exponentially. And most of the time, there's a meme that goes in life that goes like this: it doesn't matter how much money you make that's important. The only thing that's truly important is how much money you keep, and how the money you keep you can multiply. And I find, having worked with hundreds, if not I've actually worked with over 1,000 now. I've got over 1,000 clients in my company, Property Consultant that I own, consulted with over 1,000 people. And I can tell you that every single client that I've ever worked with, I can promise you from the bottom of my heart, has never come with the most optimal tax vehicle that allows the future growth of their company and offsets all of the problems I'm going to allude to and the taxes as a property investor in the UK. So the good news is, if you're watching this video, stay tuned, because you don't need to worry about taxes in property. You just need to be aware of them and understand how to manage that. And if you're somebody who's scared about taxes in property and you're not getting into property because of taxes, then I would encourage you that it's honestly because you have a lack of knowledge around tax. Because once you understand how to navigate the tax system in the UK as a property investor, you'll find that it's still a very, very tax efficient commodity going forward. So with that being said, let's jump into the spreadsheet, take a look at my client's example and show you here how this problem can compound at Section 24.
Okay, so just quickly then, so here's one of my client dashboards. So in one of my offers is called Quantum Property, and I work with existing property investors, and one of the things I help them to do is to review their existing properties, work out the best way to scale the property portfolio to maximize the growth, and to be honest as well, make it a lot more tax efficient, and send them off to the relevant people within the team, the accredited chartered accountants and the tax advisors and the barristers and the lawyers, to help them to restructure the portfolio. Now, I wanted to share this with you because I wanted to talk about Section 24, and I wanted to illustrate with you with a live example of how punitive and how disruptive Section 24 has been for landlords who have, many properties or a plethora of properties in their personal name. So this is a client. They have a property portfolio of £8.5 million. Okay, They have mortgages of £3.8 million and equity of £4.6 million, so the loan to value is only 45%. Now, one of the issues with Section 24 is this, look. So what happens is, this is the calculation. So you take your gross rental income, as I was explaining. So on this particular property, it's £3,276 per month. You minus off all your expenses, your tax allowable expenses in your private name, but you cannot offset your mortgage interest. Look, there is no longer a tax allowable business expense. You get taxed 40% on the gross rental profit before you can apply a 20% relief, which I'll show you at the end in the calculation. So the gross rental profit is your monthly rent minus your management fee, minus any monthly operating expenses, minus your service charge and ground rent, for example. Okay, and you times that by 12 to give your annual gross rental profit. So in this example, the annual gross rental profit is £31,449.60 per year before the cost of your mortgages. Okay, the interest. Now, the tax that you pay on that, therefore, is 40% of this number. So 40% of £31,449.60 is £12,579.84. Then what happens is HMRC said, well, we're not that harsh. And actually what we'll do is, we're nice really, we'll give you a 20% relief. So they said, well, whatever your annual mortgage interest payments are, we'll give you 20% as an allowance against that to claim back. So if you come over here, you take your £1,092.67 mortgage per month, you times that by 12 to get the annual mortgage. Okay, so it comes to just over £12,000 a year. And then you times that by 20%, gives you your tax allowance. Okay, so in this example, the tax allowance on this property is £2,622, and then your tax liability is your gross tax minus your 20% reducer, which means that the net tax on this one property is £9,957.43. Now, the time you take your gross rent minus off your annual mortgage interest payments minus off your tax, you're left with a profit on this property before income tax of £8,380. Now, if you look at this compounded over across the entire portfolio, and I think that there's 12 properties, 11 or 12 properties, let's take a look. There's 12 properties in the portfolio, okay? And across the portfolio, they make £505,703 of gross rental profit before the deduction of their mortgage interest payments and tax. Pretty good. Not bad. But the problem is that they've got a £202,000 gross tax bill because of Section 24. They're only allowed to offset £56,000 of that as relief. So they're paying £145,000 every year in tax, which meant that their net profit, after they've taken the 500, paid the 145,000 in tax, paid out the full annual mortgage interest against the properties, meant that their net profit is only £75,000 before any other expenses or deductions in the business or income tax is applicable. So you can see that Section 24 caused horrendous problems. Now, you might be thinking that this seems quite a lot, and it is quite a lot, but the other thing to note on this specific portfolio is that this client's interest rates, although that they were lowly geared, the interest rates on this specific portfolio at the time of doing the restructure was going back into mid 23, start of 23, maybe end of 22. And you can see that the interest rates were very high because they were on variable rates and also on capital and interest and amortization loans, which I wouldn't recommend going forward. I recommend interest-only mortgages. But even with that being said, even if they're on interest-only mortgages, still at 7.6 to 7.7, you're still going to feel it. So that Section 24 plus the interest rates just highlights the compounding problem if you have a big portfolio. So I just wanted to share that with you. Well, let's jump back over and go and talk about more taxes on buy-to-let properties.
So one of the things I want to talk to you about now as well that we've looked at the case study is I want to talk to you about the latest income tax brackets, okay? Now, I'm just going to pull up my screen here because I've got all the tax brackets in front of me to make sure I'm giving you the most accurate and up-to-date information because tax is always changing. So in your personal name on a property portfolio, you have income tax. So it's your rent minus all of your tax allowable expenses, which we're going to talk about in a second as we move through the video. And then that gives you your gross profit before taxation, and that would be your income tax. Now, income tax in the UK is taxable and you have different brackets. Now, your personal allowance, so anything that you earn up to £12,570 for the tax year April 23 to April 24 is at 0%. So you have a nil rate allowance. You can earn £12,570 tax free. You then have a basic rate tax allowance at £12,571 to £50,270 at 20%. And then you move into the high rate tax bracket, which is £50,271 to £125,140, which is at 40%. And then you have the additional tax bracket of 45%, which is £125,140. If you earn more than that, then you're at 45%, which we call an additional rate taxpayer. Now, it used to be £150,000, the additional rate tax bracket. They've recently brought that down to 125. So taxes in the UK, to be honest, they're only going one way and they're going against us. They're getting worse. We need to become more savvy, more shrewd, and more act with more perspicacity when we're making our decisions in life, in business in general, but particularly as property investors, okay? So that's the first tax. You have income tax in your personal name, okay? The next tax you face as a property investor in your personal name is you pay capital gains tax. Now, capital gains tax, just so you understand, how is that calculated? It's the current value of your property minus your acquisition costs. And your acquisition costs, otherwise termed in property, is what we call a base cost calculation. Now, we typically do a base cost calculation when we're incorporating our properties from your personal name into a company, and we typically do a base cost calculation when you're looking at what your capital gains tax is on that property, because you can create a latent gain. And this is a tax that most property investors aren't aware of. And a latent gain effectively is when your mortgage liabilities are higher than your base cost, and you create a negative number, which means you crystallize a capital gain on the latent gain value, okay? And a lot of my clients, when they come to incorporate their property portfolios, have a latent gain and they're unaware of it. Really important. You can only create a latent gain in relation to capital gains tax calculation if you own property in your personal name. There is a video on my YouTube channel, which is up here. I'll drop the link here now, where you can basically look at what latent gains are, because I'm not going to go into depth in this video. I have a whole video on what latent gains are and why you need to understand what they are. But if you are a property investor and you own property in your own name, you need to understand it. Most property investors don't understand it, and most accountants aren't telling their clients that own privately owned property what a latent gain is, or even explaining it to them. So this is what I'm trying to do today, is to inform you of that so you don't make the same mistakes that I see a lot of buy-to-let property investors fall into. So capital gains tax, 18% as a lower rate taxpayer and 28% as a higher rate taxpayer, okay? Remember, in a company, you don't have capital gains tax. You have corporation tax. We'll talk about that in a minute, but you have capital gains tax on share disposal, which again, we'll talk about in a second as we advance through the video and as we get into taxes on buy-to-let properties in the limited company structure. Now, one of the things that I want to talk about in relation to capital gains tax as well is the annual exemption allowance. So originally, back in April 2023, we had a $12,300 annual exemption allowance. So we could basically earn the first $12,300 of capital gain on a property was not taxable. It was nil rate banded, okay? And that was per person, okay? Up until April 23-24 for tax year, the annual exemption has gone down to £6,000. So they halved it. And it's £3,000 for most trustees, okay? And the other thing that I'm going to talk about is that actually in April 24 to 25, the government and HMRC are reducing it again, hitting landlords again and saying, hey, if you own property in your personal name, you've got capital gains tax, actually we're going to reduce the allowance again, and we're going to halve it again, so that in April 24 to April 25, your annual exemption allowance is only £3,000 per person and £1,500 for most trustees. Now, why do I talk about trusts? Because most trusts in the UK, most financial advisors will tell you that one of the ways that you can offset inheritance tax as a property investor is to put your property into trust. But what they fail to tell you, from my experience, is that trusts actually are taxed at the higher rate as well. So trust gets taxed at capital gains tax at the higher rate at 28%, and they have the annual exemption allowances, which are less than what you've seen in your own name, as I've just alluded to there. And you also have on the 10th anniversary of a trust, on the value of that trust, you have a 6% tax surcharge as well. So a 6% tax surcharge on the 10th anniversary of a trust. That's another taxation that you need to be aware of if you're buying properties through a trust, okay? Just in terms of taxes. So in my opinion, a normal trust, a traditional trust, which most financial advisors recommend our clients to put their properties into, isn't the most shrewd decision, because there's all these capital gains and all these other taxes on the trust that they've not really told their clients about, and the clients end up moving them into the trust and then realizing they've created a ton of tax problems with it. So again, the purpose of this video is to make you aware of these taxes. The next tax I want to talk about in your personal name is inheritance tax. Now, in the UK currently, if you own property in your personal name, you have an inheritance tax on the net equity value of your estate, and equity is current value minus liability. So it'd be the current property value minus the current mortgage liability on that property, or properties, depending on if you own one or several. Now, you have a nil rate allowance per person of 325,000. So the first 325,000 in net equity in your estate is at nil rate. It's not susceptible to inheritance tax. It's at 0%. And anything above £325,000 on a property portfolio is taxable at 40% in your personal name. Okay, that's also the same if you set it up in a limited company. You still pay inheritance tax if you don't have a smart company share structure. And again, I'm not going to go into smart company share structures in this video. I have a whole separate video on my channel all about smart company structures, family investment companies, setting up discretionary trusts with growth shares to keep it outside of your estate with capital rights. But just for this video, I just want to make you aware that you have inheritance tax as a property investor in your personal name and in an off-the-shelf limited company, because it's still accruing your estate. And you must be aware that above £325,000 in your property portfolio, in terms of net equity, the value above that is all taxable at 40% per individual. Okay. So if you're a married couple, £325,000 per person gives you £650,000 as a combined nil rate inheritance tax allowance. You also do get an additional £175,000 per person to use against your own main residential home. Okay, so if we're looking at your home plus your properties and just looking at your whole estate, then you have up to £500,000 per person, £1 million. Okay, but if you are thinking about just solely your property portfolio, you cannot use the £175,000 top up additional allowance on your property portfolio. That's only against your main residence, just to be really clear about taxation on buy-to-let properties, because that's what this video is all about. It's about, as I said, talking about all the taxes that we pay as buy-to-let property investors and updating you on the current situation as of 2024 today. Okay, so they're all the main taxes that you have in your personal name. Okay. Now, I just want to talk a little bit about how you can create a latent gain without going into the granular depths of it. One of the ways that you can create a latent gain as a property investor, if you own property in your personal name, is, let's say you've got a property and you purchased it for $100,000 and you spent $50,000 on acquisition costs. So you're in your base cost effectively £150,000. The property that you bought for £100,000 is now worth £300,000, and you decided to put a mortgage on it for $200,000, refinance it. You got £200,000 mortgage liability against a £300,000 property in your own name, and you got $150,000 base costs. Well, your base costs are $150,000, your mortgage liability is $200,000. In that scenario, we've created a latent gain of £50,000, which means that we'd crystallise a tax bill at either 18% or 28%, depending on whether we're a high rate or low rate taxpayer, on the £50,000, because our base costs are lower than our mortgage liabilities by £50,000 in that example. How do you create that situation? Most people create that situation by either refinancing the asset and not using the equity that they've released to buy more properties to put back into the base cost of the portfolio, because they're going to buy another purchase. They're going to purchase another property, which of course, if you purchase another property, you have a purchase price, you have your acquisition costs, and you have your capital costs. So effectively, you're putting it back into the base costs. But what they do is they release the equity and they either use that as income because they've had bad advice and told, hey, leverage the income, use the money and pay yourself out of that because it's a loan. HMRC won't tax the loan. But that will create a latent gain in the long term when you come to sell the property, or even if you don't sell the property, you've got that latent gain there for the future that will carry forward to your heirs, beneficiaries and loved ones. So you've got to think about these things. And the other way that people do it is they actually take that money, they refinance it, don't buy any more properties, buy liabilities, holidays, cars. Or the biggest thing I see them do is they refinance a buy-to-let property, take the equity out, and then take that money, the equity that they've released, say the $50,000 in this example, and then they go and buy their own home with it and use that as a deposit. And at that point, it moves out of the base cost calculation. So that's just like a high level definition of how you can create a latent gain when you're buying properties in your personal name. And that's a consideration. Again, you don't have a latent gain in a property portfolio if you buy it in a limited company, because you don't have capital gains. You only have corporation tax. Okay, so with that said and without further ado, let's move on to all of the taxes in a limited company. So when you buy properties in a limited company, one of the taxes that you have is you have dividend tax, and dividend tax effectively replaces income tax, or it's a like for like. It's this, you got income tax in your personal name. If you draw income from your property portfolio, you pay dividend tax. Now, I'm going to give you the dividend tax, rates and the changes. Now, the tax-free dividend allowance up until the 5th of April 2023 was £2,000. So you could take out from your limited company £2,000 a year as a tax-free dividend allowance per person, on top of your £12,570 nil rate tax allowance, your personal allowance, and that would give you £14,570 that you could extract from your salary plus profits per year from your property investment company, in this situation, tax-free. However, the current dividend allowance up until the 5th of April 2024 is only £1,000. It's been reduced, okay? So you've now only got £13,570 if we include the nil rate allowance that you can extract from the company in salary plus dividend tax-free. Now, what are the tax brackets or the dividend taxes in a limited company then? Well, you have anything up to 12,570 at 0% basic rate, £1,000 tax-free dividend allowance. Then on a basic rate of 12,571, call it 13,571 if you put the dividend allowance in there, to £50,270, that's taxable at 8.75% on the dividend. If you pull out income from your company at £50,271 all the way up to £150,000, that's a higher rate dividend tax at currently 33.75%. And then anything above £150,000 extraction of dividends is taxed at the additional rate dividend tax rate, which is currently 39.3%. So you can see that the dividend tax rate is far cheaper than income tax, but you also have corporation tax to pay in a limited company. And of course, one of the things you must understand in a property limited company and in any company is you cannot take dividends in excess of your profit. So if your profit for the company was only £10,000, in this case owning the property portfolio in a limited company, you're only entitled to take £10,000 of dividend. You couldn't take £100,000 as a dividend because the company doesn't have that profit to pay you the dividend. You'd have to take it as salary, okay? And that's a lot more expensive based on we go back to the income tax brackets then, and we have pay as you earn and national insurance contributions and all those other things that you have to pay in a company, okay? So I just wanted to kind of make that point. So what is the corporation tax then? Well, corporation tax effectively is what you pay on the company profits every year. Now, up until April 2023, the corporation tax was 19%, and recently, from April 24, we now see corporation tax at 19% to 25%, and that's a sliding scale up to £250,000. So anything from 50 to 250,000 is going to be taxable between 19 and 25% on a sliding scale, and anything from 250 above is taxable at a flat 25%. And the 19%, by the way, is a new small profit rate that was introduced for companies whose profits do not exceed 50,000. So if your profits are less than 50,000, then your corporation tax will still be 19%, which is going to be the case for many of you watching this video. Your profits will probably be less than £50,000 a year, especially if you stay tuned and listen to what I'm about to tell you, how to keep your profits below £50,000 in a year in your company as a buy-to-let property investor. If you do things a smart way and you do things shrewd, I'll show you how you can still cash flow very positively, very handsomely, but show a loss at company's house. That's right, a loss or a small profit at company's house for a number of years if you stay tuned to what I'm about to tell you and how to defer your taxes. Okay? Remember, I'm talking in this video about legitimate tax planning, smart tax planning, and how to defer taxes, not avoid taxes, how to defer them. And that's what we want to do as property investors. It's all about deferring taxes legitimately. So with that being said, that talks about and wraps up corporation tax on a company. So the next thing that you have in a company is you do have capital gains tax on the share disposal. So you don't have capital gains tax in a company on your properties. So if you dispose of any of your property assets in a company, you do not pay capital gains tax. You only pay tax on the disposal of shares. And again, there's various ways that you can freeze your shares on the day of incorporation to make sure if you start out from the right way, you build the right foundations, you set up with a smart share structure with freezer shares from the day of incorporation and freeze all the shares at a penny at nominal value, you'll never have to pay capital gains tax on the share disposal because all of your shares are going to be frozen at a penny even if the company became worth £1 billion. But in a normal off-the-shelf company, you will have capital gains on the share disposal, okay? And disposal of shares, the capital gains tax rate on disposal of shares within a property business, in any business it's the same. You have 10% at a lower rate and you have 20% at a higher rate on the value of the shares, okay? Now, let's talk about all of the allowable tax deductible allowances that we get as property investors when we buy through a limited company, okay? Because the recommendation and my overarching recommendation to you as a property investor, especially if you're new to property, even if you're an existing property investor, stop buying in your personal name and buy in the company. Now, I'm not a tax advisor, I'm not an accountant, so don't take this as advice from me. This is one man's opinion, but my strong opinion and my strong recommendation would be to buy in a limited company, because it's definitely going to be future-proofing your asset wealth for the long term, and we're all in this for long term. If you really want to get wealthy, it won't happen quickly. It's something that you're going to be building for the long term. And if you look at the long term, if you look at delayed gratification, I can assure you buying a limited company is way smarter and way more tax efficient as a UK resident, assuming you're a UK taxpayer, if you did it that way as opposed to buying in your own name. So let's look at all of the allowable tax deductible expenses in a limited company. And I've made a list of them here just so I can kind of cover them all off and don't kind of forget them as we go through the video. So the first one is you can offset all of the rates on a property. So gas, water, electric, council tax, basically your utility costs, okay? Now, if you're a buy-to-let property investor, of course, you won't really have these bills unless you have a void period because your tenant will pay them. But if you own HMO property and you rent it out professionally or on a corporate let, you as the landlord 9 times out of 10 will be paying the utility bills, the gas, water, electric, council tax. All of those are taxable, deductible, allowable business expense in your property company. The other thing you have is letting agent fees and estate agent fees. They're allowable tax deductible. Professional fees, so legal, stamp duty, land tax, broker fees, maybe structural surveys, asbestos surveys, architects fees, professional services fees that you might have as you build out your property portfolio and as you scale. All of these professional services fees are tax deductible and allowable business expenses that you can offset against your profit and loss in a limited company when buying properties in that way. The other thing that you have is lease extensions, tenant finders fees, and another big one is marketing costs, okay? Your marketing costs are a tax deductible business expense. Most people forget about this one, but let's say like even these days we run ads, like we run ads across Facebook and YouTube and stuff to acquire off-market properties and direct vendor properties, or you might run a campaign, just even a letter campaign. You may outsource that. You may have a virtual assistant who creates those for you. All your marketing costs can go through the business as a 100% tax allowable business expense. Of course, you have your finance costs. All of your mortgage interest is tax deductible in a limited company. You have your maintenance costs. Now, this is really important, okay? Because in property, you have maintenance costs, which is classified as a revenue expense, and you also have a capital cost, okay? Now, it's really important to define these because your maintenance costs, which effectively are your revenue costs, can be offset against your profit and loss. So if you're doing a refurbishment, this basically means that you're basically refurbishing the property to maintain the standard of that property. Now, it is a bit of a grey area and you will need your accountant to determine what is a revenue cost and what is a capital cost. But if I kind of try and give you a high level example, so a revenue cost would be anything that is an ongoing maintenance to that property. Maybe you've repainted the walls just to freshen it up, or you've put down like for like carpet, or you've put down some new tiled flooring because some of the tiles were chipped. All of these things are maintenance, okay? Now, If you were to basically go and do an extension to a property, add a loft conversion, do a single story extension at the back, increase the footprint of the property, that would be classified as a capital cost because it's adding value to that property. Maybe you had a kitchen in before and the kitchen was worth £3,000, and maybe it was a Greenwich Howden's kitchen, and you've now just replaced that kitchen with a £15,000 barrel top kitchen, all bells and whistles with silestone worktops, etc. That would go down as a capital cost on the balance sheet because that would add value to the balance sheet. Now, if you're a property investor and you want to defer your taxes, you want to basically try and get as much of your refurbishment costs as a revenue expense as you can, because that is 100% tax allowable business expense against your profit and loss. And if you use the Brewer method, buy, refurbish, refinance and repeat, and you keep doing refurbishments to your properties when you buy them and adding value, and 80% of your refurbishment is classified on the balance sheet as a revenue cost, of course you build up tens, if not hundreds of £1,000s of revenue expenses that go out with the business that can be fully claimed back, which basically would mean that it would take you a very long time for your property company to actually start showing a profit on the balance sheet. Let's say, for example, in 2 years, you spent £200,000 on revenue costs by maintaining all of the properties, and maybe you bought 5 or 6 properties and you did refurbishments to all of them, right? It wouldn't take much to get up to £200,000 in revenue expense for refurbishment. Well, the company has to pay you £200,000 back before you start showing profit on the balance sheet. So of course, if your assets were starting to produce £10,000 a month in cash flow, that's £120,000 a year, against your £200,000 of refurbishment and maintenance costs that have gone out, you would actually show a loss of £80,000 a year on the balance sheet, but your business is positively cash flowing £120,000 per year. Now in that scenario, it's great. It means you pay no corporation tax. You could maybe draw the money out against your director's loan, which is tax-free anyway. You don't need to show a profit. You just wouldn't be able to take out dividends because you're not showing a profit. But it depends how you're running your business and what you're optimizing for. For me, I try to show as much losses as I can because I want to defer my taxes. Because if I can defer my taxes as a property investor, it gives me more cash flow to be able to recycle. I keep more of my money and I can keep buying more assets and generate that compound effect. So again, the key is you can either make a lot of money and pay a lot of taxes, or you can make a lot of money and defer your taxes if you're smart and you know what you're doing, acting with perspicacity, and you have shrewd tax advisors to help you. So hopefully this is helping, okay? So they're the two costs, revenue expenses and capital costs. A revenue expense goes through your limited company, almost like a maintenance as a refurbishment cost. Most of your refurbishment will go down as a maintenance cost and therefore be offset against revenue, okay? And the other thing that you can do is mileage. Now you must use your mileage for the business. So if you had a car and you ran it through your personal name, because in a company you get benefit kind and all those things and company car taxes. And honestly, in my opinion, obviously it does depend on the car. If you've got a Tesla, it's 100% tax deductible, then fine. But if we're talking about normal cars with normal CO2 emissions, then actually running a lease or a company car, a company lease for a property company is probably not the best idea. You're probably better off taking that out in your personal name and claiming that expense back, because that's again a tax deductible business expense on the mileage, okay? So you get 45 pence per mile, currently up to 10,000 miles, and you'd have to show and demonstrate that you're using your car for the property business purposes, i.e. you're traveling to viewings or you're going to site because you've got a site meeting, something like that, you know? So those are most, or if not all, of the tax allowable business expenses in a limited company. So how do you work out your profit? Well, effectively, it's your gross annual rent, your gross annual rental income minus all your taxable allowable business expenses that we've just talked about, and then that gives you your profit or loss at the end of the year. Gross profit is taxed at corporation tax, income tax out the company is taxed at dividend tax, okay? Now, one of the questions that I get asked a lot is, okay, Rich, well, if I can basically show a loss at company's house and not pay any corporation tax because I'm showing these losses through maintenance costs, through the revenue costs as you've alluded to, can I carry my losses forward? Now, it's a great question. And again, this is very subjective. You must speak to your personal accountant and tax advisor whether you can carry those losses forward. But 95% of the time, majority of the time, yes, you can 100% carry your losses forward. So if one year you made a £50,000 loss and the next year you made a £50,000 profit, in the second year, that would offset the previous year of losses and you wouldn't pay any corporation tax. Even though in that year you made a £50,000 profit, you could carry the £50,000 loss forward and it becomes cost neutral. So in conclusion then, basically, hopefully that gives you an overview of all of the different types of taxes that you can pay within a property business. It hopefully gives you some of the differences between and the discrepancies between taxation on a buy-to-let property when you're buying your own personal name and you're owning properties privately, or whether you're buying through a limited company. Hopefully it updates you on the current taxes, the tax situation today, gives you a bit of a background of where we've been, where we are now, and the changes. And yeah, hopefully you like the video. So if you like the video, please make sure you go ahead and smash that like button. If you're new to the channel and you haven't already, please make sure you go and subscribe, and also click the bell icon as well so you can be notified of any new content that we bring out on a weekly basis. All right, thanks so much for watching, and I'll see you in the next one.